Joining us for today's training on analyzing self-employed borrower income. Today we are covering the very tricky C corporation. This is one that brings a lot of confusion because in many cases it is grouped together, and in many cases erroneously it is grouped together with an S corp and how it is treated as far as the borrower income. But there are very specific differences on how we analyze the income when the borrower um, is considered self employed because of ownership in the stock of a C Corp, because no one ever really owns the corporation. A true corporation is a legal entity, right? Existing separately from uh, the stockholders. So let's get right into it here in analyzing self employed borrower income for a C corporation. Excuse me. So, what exactly is a C corporation, right? A C corporation is a legal entity that exists separate from owners who are shareholders, right? They own stock in the company. They do not actually own the company. Therefore, should be noted that stockholders are not personally liable for the debts incurred by the corporation. Please note that there should be articles on the corporation filed with the Secretary of State. Uh, Profits from the corporation are distributed to shareholders via dividends. Now, it could be also that there could be W 2 wages involved, but how those are going to be considered, if it's going to be considered self employment or W 2 earnings, is going to depend on if the borrower owns 100% of the stock, right? That's the only, that's the main point that I wanted to state. That is the big difference between an S Corp and a C Corp. Uh, for a C Corp, for a C Corp borrower to be considered self-employed, the borrower needs to own 100% of the stock of the corporation, and they also need to own 100% of the stock of the corporation in order to use. Oops, what happened? Sorry about that. In order to use any of the income or to have any losses counted against them, against their income. Now, this is probably the most important point. So and I'll touch base on it a little bit further. But with that being said, please note that, again, touching back on the point, borrowers who receive W 2 income are still considered employees if they own less than 100% of the stock. Uh, and losses are limited to the amount of investment in company stock, right? Now, note that right there, right? That's very important points because I've gotten into this discussion in many files where the borrower may own a certain percentage of the stock. Let's say they own at least 25% or more. And for an S corporation, 25% is the benchmark at which a borrower would be considered self employed. But that is not necessarily the case for a C Corp, at least not when you have a Fannie Mae or Freddie Mac or any other agency loan. Now, if it's a non QM loan, I have seen guidelines where they will state that anyone who owns 25% of an S Corp or owns 25% of the stock of a C Corp is considered self employed, but those were exceptions to the rule, right? I think in all the deals I've done, I think I ran into one guideline for one investor that had that in the in their guidelines on how to interpret self-employment, right? But as for typically, and if you look at any of the training and guidance on income, it is going to state that for the income to be able to be used by the borrower, for the C Corp's income to be able to be used by the borrower, and for the losses, just as important, for the losses to be considered against the income of the borrower, the losses of the corporation, the borrower has to own 100% of the stock of the company. And then the other point is going to be that their losses typically are limited to the amount of stock that they own. So trying to attribute all the corporate losses to the borrower if they own 100% of the corporation's stock, is not usually something that is going to happen. So again, this is the main point to consider when you're reviewing a borrower that has a C Corp. Ask them if they own 100% of the stock. If they do not own 100% of the stock, then you should be good. Now, how would you show their ownership? Well, it may be a little tough because it's not always possible to obtain the corporate tax return, the 1120S. Maybe they would be willing to show the 1125E, which is the compensation of officers schedule in the 1120S. That's the one that states, how much is their percentage of ownership and what is the distribution that is being given to that borrower. Now, please note that typically, if it is a self-employed borrower, now if it's been determined that they do own 100% of the stock, so they would actually be considered self-employed. I mean, unless you're submitting your file to that one investor that is an exception at 25%. But assuming you do have 100%, a borrower that owns 100% of the stock, then for them to be considered self-employed, you would typically need a 2-year history, right? This is going to be the same as any other scenario. Couple of exceptions: borrower receiving same or greater income in a similar field or position, or borrower in a similar occupation in which they had similar responsibilities. Now, this may be a little bit tougher when you're dealing with a C Corp as opposed to when you're dealing with a sole proprietor or dealing with an S Corp, but those would be the only way to grant exceptions to the 2-year rule. Now, as far as the income stream, right, how do we track it, right? So the income and expenses, in other words, a profit and loss of the true corporation is reported on IRS Form 1120, which is the corporate tax return. Please note that do not confuse this with the 1120S, as in Sam, which is the S corporation tax return. So for the C corporation, the true corporation, it is simply Form 1120S. So that's where all the profit and loss is reported. And then the distributions are reported on Form 1125E, and that is if the gross receipts of the company exceed $500,000. At that point, then, those distributions are dividends on the 1040 Schedule B. That's the 1040 is a personal tax return of the borrower. Schedule B, that's where the dividends are reported. So please note that dividends aren't always, from stocks, from an investment in the quote unquote the stock market, but it could be actually where you have a substantial investment in a corporation to the point that you're named on the 1125E and getting a substantial portion of dividends via distribution. Now, there's 2 ways that the borrower is going to get income from that corporation. One way is through dividend distribution, and the other one is through actual W-2 wages. And now please note that they're considered W-2 wages for an employee if they own less than 100% of the stock of the corporation, and they're considered a distribution if the borrower is 100% owner of the stock. Now here we're talking about the W-2 wages. We're not talking about dividends distribution, but actual W-2 wages, which is just another way to get the money into the borrower's hands. And then also please note that another income document that you will need if actually using the income from or losses from the 1120 is going to be the year to date profit and loss report. Whenever we are beyond the first quarter of the year, right? So after March 31st, that's when the first quarter ends, you are going to be required to provide. And this again is assuming that the 1120 is required, right? Because our borrower is 100% owner of the stock. So if it's after March 31st, you're also going to need a year to date profit and loss report. So if the application, for example, is in May 15th, we'll probably ask for a year to date profit and loss through the end of April, right? So you would have the year to date profit and loss report. You'd have, I guess, if this was 2025, right? Or let's say it's 2024 right now and the application is now November, you're definitely going to need the year to date profit and loss report through October 31st, 2024. And then you will also need the 2023 tax returns. And depending on your findings, if this is an automated underwriting loan and they tell you 2 years, then you would need 2022 as well as 2023 in the year to date profit and loss for 2024. If AUS says you only need 1 year, then you only need 1 year. And again, very importantly, this is assuming that that the borrower is 100% owner of the stock, and we are considering them self-employed, and we are asking them then for the 1120 for the corporation as well as their 1040 year-to-date profit and loss. And if they receive any W-2 wages, obviously we need the W-2s, pay stubs, just to confirm that type of income. But again, if they're 100% owner, that's going to be a distribution, and that W-2 wages will be included in the self-employed borrower income calculation. So that's either going to be the form 1084, which is the Fannie Mae form, or the form 91, which is the Freddie Mac form. Now, I will state that Freddie Mac is a little bit more geared towards self-employed borrowers. We all know how, if the business has been in existence for at least 5 years, Freddie Mac automatically gives you the 1 year tax return findings, versus Fannie Mae is only going to give you that findings if there is low risk in the deal. But one thing you definitely want to note on any of these businesses is, does the business have liquidity, right? That's the key. Because if there are W-2 earnings and stuff being paid to the borrower, and if there are distributions, we want to make sure that the business has liquidity to continue to pay. So you would run a liquidity test, or our liquidity calculators. But liquidity is basically assets minus liabilities. One of the biggest categories that's going to come into question here are mortgages held for more than a year, or mortgages held for less than a year. That's another component in the liabilities. Because if it's a line of credit that continually renews, we may be able to exclude it since it is not a long-term loan, right? So, but the business has liquidity if assets are greater than liabilities. But before I go on into the next and final slide, I want to remind everybody the key takeaway from this page, and probably the key takeaway from this whole presentation, is that a C corporation borrower has to own 100% of the stock of the corporation in order to be considered self-employed. and they have to own 100% of the stock of the corporation in order to be able to use the income or have losses considered against their income. That's the most important takeaway from this whole presentation today, because that's the argument I've used many times when they get start asking questions on that 1120 tax return. And as long as you can prove that the borrower is not 100% owner of the stock, you can usually stop them cold in their tracks. So this is similar to the key concepts on the items that can be added back or have to be counted against the borrower. This is the same on an S-Corp as well as a sole proprietor, right? So we have non-cash expenses, which are expenses that are added back to income. So when you're completing your income calculator, very important to note these items. The income calculator will tell you where to find these on the 1120, on the 1120S, as well as on the Schedule C. So non-cash expenses would be items such as depreciation, depletion, or amortization. And I'll be clear, amortization does not mean paying down of a mortgage. In this scenario, amortization is a one-time business startup expense, right? The surveys, all of the work that had to be done, setting up the business, paying accountants, getting patents, copyrights, whatever it may be, the expenses to start up the business, because that's what amortization is, one-time business startup expenses. Depletion, exhaustion of natural resource, and we all know what depreciation is. It can either be on real estate or on personal property. Another key concept here is expenses limited by the IRS. And specifically, the most common one in this category are meals. Now, what do they mean by expenses limited to the IRS? Well, meals, the IRS only lets you deduct 50% of the meal, which means there's another 50% floating around out there that's an actual expense. In the income calculations, you're asked to add that expense back, which will be deducted from the income, right? So the 50% that wasn't deducted as an expense will be added as an expense. So if it's $5,000, then it's $5,000 to reduction to the income in the income calculator. And last category we have here is recurring versus non-recurring income or loss. This is a very important category here, because especially on the non-recurring loss part, the non-recurring income, if it's non-recurring income, we know we can't use it, but it's always good to have the borrower reach out to the accountant, or we can reach out to the accountant and find out what type of income was that non-recurring income, just to ensure if we can or cannot use it. But what we're really going to focus more on in this category is on the non-recurring loss. That's the one that's affecting you as well, because it's on there. But the fact of the matter is that is a paper loss, right? The recurring loss or recurring income, when it's recurring, is expected to continue for at least the next 3 years, right? So we've got that 3-year rule there. And versus non-recurring, which is a one-time event that cannot be considered towards income nor expenses. Now, what would be some categories on this? Well, we have, for example, the sale of an asset like a vehicle or equipment, where the business is not in that type of business. We have a casualty loss, right, which is like an insurance claim. You had to pay deductible of $5,000 out of pocket, or maybe insurance didn't cover, or maybe it was theft and it was under the deductible. Whatever is the out-of-pocket loss on a casualty loss can be written off, or a paper loss that is carried forward, right? That tends to be the more common ones, where 5 years ago they had a big loss, and due to some IRS rule, they allow you to spread out the loss over a certain number of years. So as long as we get documentation from the accountant as to what is the nature of this loss, then we may be able to get that loss excluded, right? Which will improve our income and hopefully our DTI. So this is very important, and this is where you would be working with the borrower and with their accountant for any type of these explanations on the recurring versus non-recurring losses. It's several times I've been able to reach out to an accountant on a one-time loss, on a non-recurring loss, and have been able to get it waived and have been able to close a loan based on that. Without that, we were over. With that, we are under. So that completes our slides, and I wanted to see. I don't see anyone with any question. Okay, I do have a question here. Is an LLC considered a C corporation? Nope. An LLC is just another entity, but it is not, definitely not considered a C corporation. I'll have LLC on next week's training, so you could compare. But the C corp is the one that where the borrower is most removed from ownership and the liability of ownership, as the name implies, right? It's a legal entity existing separately from its shareholders. All right, so I'm not seeing any additional questions here. I'll give it a minute because remember, I mean, C corp, S corp, sole proprietor. Those are the three entities that we've covered so far. They're all a little bit different and very important to know. Well, no additional questions, so it looks like we are done for today. I do appreciate you all checking out today's training, and look forward to seeing you next Tuesday. Have a good rest of your day.